Remember when JEPI was the hot fund? It was outperforming tech funds a year ago. Now its little sister JEPQ is the hot fund. In March, it took off like a rocket and it hasn't looked back. The one-year total return for JEPQ is currently 28%. That's double what JEPI delivered. On top of all that, JEPQ is paying a higher dividend, more than 11%. It's time to see why this little sister won't be little for much longer. Last month, I did a deep dive on why JEPI has been underperforming the S&P 500. Today, we'll look at why JEPQ has been performing so well. JEPQ and JEPI are not really direct competitors, but most income investors who look at one will at least consider the other because they use the same strategy and they have the same portfolio manager, Hamilton Reiner from JP Morgan. JEPQ's direct competitors are the funds that focus on tech stocks like QYLD from Global X, BST from BlackRock, and STK from Columbia Threadneedle. We'll take a look at how JEPQ stacked up against those three. You might not have heard of that last one, but stick around because it's a sleeper that's definitely worth a look. I always start with income before going into the details of a stock or fund because if the income isn't good, I don't think you want to know about all the other stuff. That juicy 11.78% yield is based on trailing 12-month distributions. To give you an idea of range, if we annualize the lowest distribution from the past 12 months, 35.66 cents from June, that would equate to a yield of 9% on today's price. Not bad. Then if we annualize the highest distribution from the past 12 months, 68.13 cents from November of 2022, that would equate to a whopping 17.28% yield on today's price of $47.30. So even though there's a lot of variation, anything in that range is pretty healthy. The JEPQ distributions vary so much because apart from a small amount of dividend income from the stocks in the portfolio, most of the income comes from selling covered calls. Unlike most covered call funds, JP Morgan outsources the sale of covered calls to banks using equity-linked notes, or ELNs, to generate the income. These debt instruments and covered calls in general are explained in the JEPI review video. But for a quick catch-up, the fund is selling away the rights to some of the upside of the portfolio in exchange for payments called option premiums. JEPI's ELNs sell call options on the S&P 500 index, and JEPQs are sold on the NASDAQ 100 index. The premiums that the fund receives as payment increase or decrease with market volatility, which explains why the distributions are constantly changing every month. The S&P 500 volatility is measured by the VIX, you've probably heard of that one, and the NASDAQ 100 volatility is measured by the VXN. Looking at them together on this chart, we can see a few things. Firstly, they're correlated, meaning they mostly move together. Secondly, the one JEPQ uses, the VXN, is mostly the higher of the two, which would explain why JEPQ has been earning more income than JEPI. Also, we're looking at percentage movement, not absolute values, so VXN volatility is actually higher than it appears on this chart. Sometimes there are exceptions to that trend. For example, in March 2023, the banking crisis affected the S&P 500 more, at least on a percentage basis, because it contains more banking stocks. Last of all, the obvious trend is that volatility has been declining over the past year. Generally, that's good for stock prices and bad for covered call income. A quick disclaimer, I'm not a financial advisor. Since retiring in 2017, I began researching my investments in far greater depth because now they pay for everything. When I find something interesting, I make a video. The JEPQ review explains in detail how JEPQ is constructed, but the short version is that they use 80 to 85% of the fund to select some stocks from the NASDAQ 100. Then they mix in a few value stocks to reduce volatility. For example, AbbVie is a pharmaceutical company with a yield of roughly 4% and a fast-growing dividend. It's not in the NASDAQ 100, but it is one of JEPQ's holdings. The hardware store, Lowe's, is a dividend aristocrat, meaning it's raised its dividend each year for more than 25 consecutive years. Pretty impressive. It's not in the NASDAQ 100, but it is part of the JEPQ portfolio. Then in addition to all of that, 15 to 20% of the fund is used to buy ELNs that generate income as mentioned earlier. The result is a fund that is far more tech-focused than JEPI, but not as tech-heavy as the NASDAQ 100. In March of 2023, tech was rebounding off its correction that lasted most of 2022, allowing JEPQ to catch up to JEPI. Then in May, Nvidia announced that AI was going to make them a money-making machine, and big tech, aka the Magnificent Seven, went on a tear. This was good for JEPQ because the Magnificent Seven makes up 37% of their portfolio. It didn't really help JEPI much because the Magnificent Seven is only 6% of that portfolio. Even though JEPQ uses the NASDAQ 100 as a benchmark, it's not designed to keep up with it. First of all, the covered call option strategy sells away some of the upside. Secondly, the stocks they have in common are weighted differently. Remember how the Magnificent Seven make up 37% of JEPQ? Well, they make up 44% of the NASDAQ 100. And thirdly are those value stocks that aren't in the NASDAQ 100, like Lowe's Hardware that I mentioned a moment ago. Given these last two reasons, the overlap between JEPQ and the NASDAQ 100 on a weighted basis is 67%, so they're not even close to identical. Watching JEPQ's price action since that review I did back in January 2023 has increased my confidence in the fund. It was so new back then, there was less than a year of data. Also, the inception was during a terrible year for tech, so it was unclear if JEPQ was equipped to bounce back after taking those losses. The issue with covered call funds is they're exposed to 100% of the losses of their underlying index, but the exposure to appreciation is potentially less than 100% if the index appreciates too quickly. The good news is that now we have some data to look at. JEPQ was able to experience some appreciation in 2023, only about half as much as the NASDAQ 100 for the reasons I mentioned a little bit earlier, but a gain of almost 16% in just over 9 months is impressive for a covered call index fund. That's slightly more than the S&P 500, which is a different index, but it's a yardstick we can use for a bit of perspective. Then when we include distributions to measure total return, JEPQ's numbers are even more impressive. Almost 26% in just over 9 months, which puts it between the S&P 500 and the NASDAQ 100. The upsides for a tech fund like this are a continuation of the AI boom and the Fed lowering interest rates. The AI boom is speculation, so I'm not relying on that. The Fed pivot is likely, but the timeline is completely unknown. It could be months, could be years, who knows. There's also an upside for the income of the fund if volatility of the NASDAQ 100 increases. And given how low volatility has been in recent months, that seems like a real possibility. The market, and the world for that matter, doesn't stay calm forever. The downside for this fund is another tech correction, which is always a possibility. If there is another major tech correction, it reduces the assets of the fund, which are used to buy those covered calls, and a sustained major correction would therefore result in lower distributions. Before we compare JEPQ's performance to those other tech funds, a significant chunk of the charts and information for this video came from Seeking Alpha. I'm on the Seeking Alpha app or website every day. It's not an addiction because I can stop anytime I want to. I'll put a link in the description for a free trial and any promotions that they're currently offering. There's also a link down there for free stocks from Webull if you open an account, which you might want to do because they're currently paying 5% on cash. I've mentioned JEPI and its benchmark, the S&P 500, a few times, but the real competition for JEPQ comes from other income-focused tech funds. Examples I've covered on this channel include the QILD Covered Call ETF and two closed-end funds, STK and BST. JEPQ doesn't have a long history, but let's compare total returns. Since JEPQ's May 2022 inception, and it's worth noting again, 2022 was a terrible year for tech, JEPQ is leading the pack. And the good news is it has recovered from the losses of 2022. If we shorten the timeline to just the past 12 months, the total returns are even higher. JEPQ is neck and neck with STK, which has spent most of the past year way ahead of the pack. I thought JEPQ looked promising when I first reviewed it almost 10 months ago. Now, after watching it react to a tech correction, followed by a tech surge, I like it more. Specifically, I like the yield, the growth, and the low volatility. Even though the distributions vary, the yield is still above 10%, and that's higher than I would expect, given that we're in a period of very low volatility. JEPQ offers some exposure to tech growth, not as much as the NASDAQ 100, but enough to know that the potential returns are greater than just the yield, which is already pretty high. And then regarding volatility, I'm okay with giving up some of the total return of QQQ or the NASDAQ 100 in exchange for less volatility. The NASDAQ 100 is all the rage now, but remember back in late 2022, it was in free fall. And as a retiree, I'd rather be down 13% on a fund and earning 10% yield with JEPQ than down 20% with almost zero income from QQQ. I'll admit that JEPQ's higher yield does make it more appealing than JEPI at the moment, but I continue to hold both because they perform differently as growth is overbought and then oversold. Going back to that comparison chart, if SDK caught your eye, it doesn't really get a lot of publicity, but it has an excellent track record over the long term. Going back 5 years, long before JEPQ was created, we can see that SDK was delivering more than double the returns of QYLD or BST. Then if we go back 10 years, a 422% total return is also pretty impressive. If you're interested in tech funds that produce a combination of income and appreciation, I'll put a link to the SDK review in the top right-hand corner of the screen. That wraps it up for this JEPQ update. More armchair income coming soon.